That's it. That's it. That is me, Dr. Boogie. Dr. Love. Me, moi. Dr. Lover. How you guys doing? What's going on? Please, before I start, a lot of you forget to like. Please like, subscribe, share. Please, blah, 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 blah. So, last time I had a video talking about the MACD crossover and the signals that might take place in the put to call, and I said it's gonna take up to 6 days next week. I talked about the MACD crossover with the stochastic, and this thing is in effect. So as I said last time, it's going to be maybe not next week. All right. So what's going on today? Are we reaching out extreme in stochastic reading, which has only happened twice in the last 5 months, 6 months. The first one took about 3-4 trading days. That will come at the same time with the MACD crossover and the put to call. Okay, so after that, a major flush happens. Second time this happened, we had a bull flag, then another leg up. Then we had a bearish divergence, and we had a severe leg down from 29,000 to 26,000 something. This is major. This qualifies as a correction in the healthy market. That doesn't happen that often. One thing you would know if you've been in the market for some time, if you have these types of corrections back to back, that's not a healthy market. That is not a healthy market. And if you have these violent moves to the upside, that's not a healthy market. This is indicative of bear market rallies. If you go back in time, this is not normal. You do not go that fast, that severe to the downside all the time. It's like it became like every 3 months. This is not a normal market. Take it from me. So to conclude the Dow thing, that what got my attention is the high reading of stochastic and the duration that this reading could be sustained. Last time about 4 trading days, and boom. And before that, no, sorry, this is the time before. And last time, it took from August 10th to almost 20 trading days, and produced a very ugly bearish divergence. At that time, it was producing a beautiful bull flag that I mentioned before, and I was bullish for this one right here. This is easy bull flag, and boom. And it was easy too. So this is the Dow. So we talked about the extreme and what happened in the past with that extreme. Good deal. So let's talk about the put to call and what's different. The put to call here, the total put to call, is leaning toward the bullish side, but it's not extreme at all. This one, as I said before, time and time again, this thing should be an insurance. The exchange traded funds, ETF put to call, this should be an insurance. So this should have an inverse relationship with the equity put to call. So this should be almost 101, 102. That shows that portfolio managers hedging their bets. But even though it's not extreme, but that means the portfolio managers are not hedging their bets. And this point is extreme. Throughout the years, this is not sustainable, even though we've been going through this since at least the last 3 months. But it's not a bullish sign anyway. But what caught my attention this time, and is what is different between this time Last time you have a bearishness in the VIX was in June, and in June you had almost 6% in one day. You have a flush of 6%, 6.5% in one day. So this shows the participants are really all betting on an up market, low VIX. Go all in. If you look at the chart and look at the history, usually the best bull market does not happen when everybody is optimistic. They always say bull market go up and go up, go over worrying walls. I forgot the bull market go over worrying walls. That means everybody's worried when they buy. But these numbers that doesn't tell me that thing. And what's different about this protocol than the last 2-3 months before June flush is the VIX. People now are giving up. Okay, good deal. So this is the VIX. This is the VIX chart, and it shows bullish development, a saucer type of formation, which usually produces direction and change direction, like what happened here. So I really don't know. There's no signals that nothing is showing me here. But the only bullish thing is the saucer. So this is for the VIX. Okay. Let's look at the put to call. The put to call. As I said last time, this produced a major pullback, which showed itself. The 20-day moving average going over the 50-day moving average, which proved itself over and over and over and over again throughout the years, and it's still in effect. And usually, when you have a bearish crossover, you have a major up move in the market. There's an inverse relationship between this and this. So this happened here, October, before you made the all-time high at that time of the Dow, and it happened also, yeah. So this is what shows. So a bearish crossover means high market. Yet there is a bullish crossover in the stochastic. Usually, stochastic it gives a lot of signals. It's not as reliable as the MACD yet. It gives us an introduction to a possible MACD crossover. So once this bad boy goes up and this thing crosses over, this is what happens. And as I said last video, I said it's not going to be an immediate signal, as it's 6, maybe 5 trading days. And I'm still sticking to my guns. So I'm doing. If you look at my videos, I don't delete them. I really don't delete them. And I'm hoping that I'm a reliable person. I don't lie. I have no incentives really. So according to this signal, next week you might go over 20. At that time, this MACD crossover might take place, and this thing's still in effect. Okay. And a major pullback might happen. So this is the put to call, the daily time frame. This is the put to call weekly time frame. And you see a beautiful, beautiful bullish divergence. With beautiful bullish divergence here in stochastic in the weekly time frame. Last time something like this happened. Whoa! So these things repeat themselves. It doesn't happen like it's collective psychology. These things happen. I don't know what's the causation of this major pullback is going to be. I really don't. But this is the chart's telling me there's a major move, and also this is a bullish candle. It's not really a hammer, but it shows a price rejection from an area that it was 38, I think 38, let's see, it's 39. This area is always not sustainable at all. It's sustainable in put to call. always produces a pullback in the market. How about that? And it touches it like suddenly and changes course all the time. And let me put the line so you could look at it. If you notice, as I said, so this did the signals that it always does. Look how sharp this angle is. So this area is area of buyers. In this case, sellers. People just turn bearish here. That's what happened here in June. That's what happened here in September. It happened in many pullbacks here, and also here. So in conclusion, let me recap what I said. And this is the stochastic I told you about. Okay, let me recap what I said. So I conclude everything. It reached, the put to call reached the extreme point, and now it's giving me the sharp angle. The stochastic is a bullish crossover. It gives me an introduction to the MACD crossover that might take up to 6 trading days. Okay, good. So you understand this part, a bullish crossover in a bullish divergence in the weekly time frame for the put to call that worked in the past. There's nothing wrong of it if it's gonna work this time. A beautiful saucer formation in the VIX that came with an extreme bearishness in the VIX. This is 2. C1 is a balanced power. This is 2 or something. So this is the first time since June where people turn bearish on the VIX. This should be an insurance for the exchange traded fund, and it's not here, even though it's not extreme. We are still in extreme in equity put to call. The Dow Industrial gave us a very extreme reading in the stochastic reading that historically did not sustain itself for many days. Many times it pulls back severely. The longest duration was last time 20 trading days with bearish divergence. A lot of smart money would never buy this one at all. So they would have bought this bull flag, then sold right away. And this thing produced, it was multiple, as I said last time, multiple measure moves. It was 127 Fibonacci extension of this move and 121 of this move. So it was a very heavy area of sellers that gathered in this area right here. And also, yeah. So in conclusion, I'm not here to be a very dark person that wants everything to go down. I'm just trying to look at evidence that collective mass madness might backfire. And historically, the market go up and up at worrying times, not in euphoric times. Good luck, everybody. Please don't forget to like, subscribe, and share if you want that more. If you want more of this stuff. And it's okay to say your opinion. Don't be shy. Don't be shy at all. Love you, all. I love you, everybody. Stay true to disco. Stay true to love, equality, and love for everybody. And disco's forever.